Hey traders, this is Jeff from ZenTrader.ca. Major allergy season here going on in Vancouver. That's why my voice sounds so funny. I feel so stuffed up, but I've got charts of the Dow, Nasdaq, and VIX that I think are pretty significant, and then the rest of the time I've just got some other individual stock charts to go over that I think there's some importance to these charts. So with the 60-minute chart of the Dow Jones, I just wanted to point out here, we went into oversold here in March, and then basically that was a fake out. We rallied to new highs, and now we're back flirting with, well, we went oversold again. And why is this significant is because we went basically all of December, January, February, never going down quite to that 30 level in the RSI. Now that we've gone down, rallied up to new highs, and now we're back down here, I think that this could really be the start of a sell-off here. And when you look at this chart, what is significant about this? We had a massive volume, 2 billion shares on the Nasdaq, and we didn't go anywhere. This is classic churning. And on this day, the Dow and the S&P both had massive volume, as did the Toronto Stock Exchange. I just see, let's just take a look at this chart. We had a breakout, follow through, churning, a last gasp up, an inside day here in the candlestick, another last gasp up to retest the highs, failed, and then a sell-off day today. And when you look at this day, when the market, the day after the churn, the volume was significantly under average. This is a bit, even though this looks bullish, this is a bearish day in my opinion. Bearish day, another bearish day. So, in my opinion, all 4 days after this churn day have been bearish, even with it going up. So, and then the last thing is volatility continues to go down, and this is just a dangerous combination when you've got a market top with volatility approaching extreme levels of complacency. That when the volatility does kick up, there's a lot of room. There's a lot of downside room here. We could easily come back to the middle Bollinger Band. And that's only a 60-point drop. But, this chart's not really a good chart to really show you how much room, because this is just a 2-month chart. But there's a lot of downside that we could see. Cisco, rising bearish wedge here, could easily break down there and retest the lows. There could be a bottom. This could be a potential double bottom in the long-term chart, though. I don't think this is going to go all the way down here, but my point is this is a downside break waiting to happen. The RSI is kind of stuck around that key 60 level. Ford hasn't been able to get over resistance. It's looking like it's rounding, and it's looking like it's starting to roll over. TLT, I talked about this the other day. 109 was my support line in the sand. It looks like it's trying to put in a bottom here with a candlestick. Also, the 60 level for bearish levels, 40 level on the RSI for bullish levels. So we are above that. We're at 46. That's key. McDonald's hit resistance at 100, was stuck in this channel all the way up. I like McDonald's. I like it around 90. I think that would be a good entry point. But it's very significant that $100 is often a psychological barrier. And then two retailers that I think are just ridiculously overbought. UA, Under Armour. I think 100 is going to probably be a cap for that. And Lululemon, the stock that everybody thought was done back here at the end of last year, has just went on another phenomenal run, going from 40 to 75, almost a double. Without looking back, I think this stock's close to the top two. You've got negative divergence here on the RSI as well. So trade them well, guys.